Learning objective 12.4, use ratios to make business decisions. Now we did vertical analysis, which began to introduce us to what we refer to as ratio analysis. And so what we're going to be looking at when we're actually conducting ratio analysis, we're going to be measuring the ability to pay current liabilities. That's one type. This is kind of a category, and we have a number of ratios we use to really understand a company's ability to pay its current liabilities. The next set of ratios we'll look at is turnover and cash conversion cycle. The next set will be the leverage and the company's ability to pay its debts. The next classification is profitability. And then the last classification we look at is analyzing stock as an investment. Okay, and this is kind of a reminder that one thing I've already mentioned to you. Whenever we're doing analysis, we're going to likely do the ratio computations for one company, but we have to compare it to something else. We can't, the numbers by themselves are going to be almost meaningless. But if we have the ability to compare that number to something else, like another company, or even better, the industry average. Well, if we have the industry average and we can look at our numbers and we can compare them, are we doing better or worse than the industry? And that's a good way to understand whether we need to make adjustments. Now, not only can we compare our numbers to industries, but we could also compare our numbers to ourselves. Are we getting better at this? Every year we'll look, is it improving, or is the number not improving? So let's go ahead, let's flip back one slide. We have the classifications. The first thing we're going to do is look at measuring the ability for a company to pay its current liabilities. Let's look at that set of ratios, okay? Measuring the ability to pay current liabilities. That's 2 slides down from where we were. All right. What do we got? We have working capital, current ratio, and the quick or asset test ratio. These are 3 commonly used ratios to determine if a company can easily pay its current liabilities. Okay, so let's look at the first ratio, working capital. Working capital is simply taking current assets minus current liabilities. Well, we're going to flip back to the balance sheet of Under Armour. We'll focus on 2016. Now, if you look, total assets are listed here, but you could see right in the middle, or close to the middle, there's a subtotal that gives us total current assets. So the current assets, 1965153. So for Under Armour, working capital is equal to current assets minus current liabilities. So all we have to do is then take a look at the numbers. So working capital is equal to the current assets. Well, the current assets, 1965153, 1965153. And we're going to subtract from that current liabilities. Current liabilities, using the spreadsheet listed in this PowerPoint. Current liabilities, total current liabilities, 685,816. So working capital equals 1279337. Working capital equals current assets minus current liabilities. The next ratio is called the current ratio. The current ratio looks at the same numbers, but rather than subtracting them, you have a division. And the current ratio is computed by taking current assets divided by current liabilities. Current assets divided by current liabilities. Now we already got the numbers from the balance sheet for working capital because we're using the same numbers. The difference is we're doing a division rather than a subtraction. So current assets, 1965153 divided by current liabilities, which is 685816. So the current ratio equals this number divided by this number, which is 2.87 rounded to the nearest hundreds. These two ratios are really using the same numbers, and they give us some info. Each one gives us a different feel for what the number means. But for working capital, we're looking for how much do we have in current assets available to pay our current liabilities. The definition of a current asset is an asset that is cash or will convert to cash within 1 year. A current liability is any liability that matures within 1 year. So that difference, what we do want to make sure is that our current assets are larger than our current liabilities. In this case, we do. We have that 1.279337. So this is good news. If this were a negative number, we'd be really concerned because what we're saying is we don't even have enough current assets to pay for our current liabilities. That would be concerning. The next ratio, the current ratio, really uses the same numbers and the same information, but it gives us a relative feel. See, we have 1.2 million more in current assets than current liabilities, but when we look at it from a ratio perspective, it gives us a better feel for what that really means, or comparatively speaking, what that means. So we'll take this and we'll divide it by that, and that's going to be 2.87. That tells us that we have $2.87. This tells us that for every dollar of current liability, we have $2.87 of current assets. So that's more than double, almost triple of what we have here. So that gives us a really warm, fuzzy feeling about this company's ability to pay its current liabilities. The quick ratio, or the asset test ratio, is really the same as the current, except we're going to be a little bit more specific about current assets and really look at liquid, very liquid, highly liquid assets. We're going to look at specifically cash and cash equivalents, plus short-term investments, plus net current receivables. Those are excluding things like inventory and prepaids. And what that's suggesting is that I want to look at it from the perspective that if the company sells no more inventory, if it doesn't have any more sales, can it still meet its current liability obligation? Can it still meet it? And that gives us a little bit better feel as to what it's about. We're expecting 0.9 to 1. Any kind of computation from there means it's acceptable in most industries. But let's take a look at what it looks like for Under Armour. Now, let's go ahead and put the quick ratio here. And that's equal to cash and cash equivalents, short-term investments, plus net current receivables. And now we're just like the current ratio, we're going to take the sum of those three numbers and we're going to divide it by current liabilities. Now when we're looking at specific dollar amounts, well, the good news is we already know what this is. So current liabilities is covered. We know this division carries down, and we know that this is a computation of the quick ratio. The question becomes, what is cash and cash equivalents, short-term investments, and net current receivables. Let's go back to the PowerPoint. Let's go back up the PowerPoint to the balance sheet of Under Armour. And we have it right there. The first line item is cash and cash. By the way, we're going to use 2016 in this computations. So cash and cash equivalents, 250,470. Short-term investments, doesn't appear it has any, so we'll put 0. And the last one is net current receivables. Accounts receivable net is 622,685. 622,685. So cash and cash equivalents came from here, and accounts receivable net came from here. We have 0 for short-term investments. So let's scroll down here. Go down to the next step here. So now we can sum up this plus that, and that gives us 873,155 divided by 685,816. So the quick ratio in this example here is going to be 873,155 divided by 685,816 to the nearest 100. We're at 1.27. Well, like I mentioned to you in the slide points that out. We're going to scroll down to where we are. Quick ratio. A rate of 0.9 to 1 is acceptable in most industries. So we're at 1.27. So we're definitely pleased that this is higher than 0.9. Definitely pleased that it's higher than 1. So what this suggests to me is that even if Under Armour doesn't sell one more product, it still will be able to meet its short-term obligations. It can go a year without selling anything and still survive. Okay, so let's go back to the slide 1, 2, 3, 4, 5, 6, 7, right? We just looked at measuring the ability to pay current liabilities. The next classification we're going to be looking at is turnover and cash conversion cycle. Measuring turnover and cash conversion cycle. So let's see how many ratios we have for that. All right, so this slide, it's slide number 28, gives us 1, 2, 3, 4, 5 ratios that we use to measure the turnover and the cash conversion cycle. The first one is inventory turnover. The second one is accounts receivable turnover. The third is days sales outstanding. The fourth is accounts payable turnover, and then the cash conversion cycle. Let's look at inventory turnover. Inventory turnover measures a number of times a company sells its average level of inventory during a year. This varies widely by industry. And again, we're going to compare to prior years and to industry average. So we're going to take the inventory turnover, what it is for 1 year, and compare it to prior years and or compare it to industry average. So the computation, the formula is the inventory turnover is equal to the cost of goods sold divided by the average inventory. So if we compute the inventory turnover rate for 2016, that's Under Armour's turnover for 2016, we're going to need the cost of goods sold. This comes from the income statement, and we're going to divide that by the average inventory. Before we go any further, we have to compute the average inventory. The way we come up with the average inventory is we're going to take the ending balance of inventory, we're going to add to that the beginning balance, and we're going to divide that by 2. So in this example, for inventory turnover or inventory for 2016, we're going to go to slide number 11, and we have inventories. Ending balance was 917,491. That was for 2016. Now the beginning balance is equal to the ending balance of the prior year. So that would be 783,031. Those are the two numbers we're going to be using. We're going to add them together and divide it by 2. So 917,491, 783,031. We're going to add those two together, and that comes up to 1,700,522. That is going to be divided by 2, and that gives us the 850,261. So that becomes our average inventory. From here, we're going to go back to the original formula. We've just figured out what goes here, which we'll plug in here. This is the 850,261. We just computed it, and that goes here, average inventory. Now we need to figure out the cost of goods sold. Well, we'll go to slide 10, and we'll see that on slide 10, you have the cost of goods sold is equal to 2584724. 2584724. So we're going to take that number divided by the average inventory of 850,261, and that gives us 3.04. So what this is telling us that on average, the company is selling the average balance in their inventory in dollars, the average inventory dollar balance, on average, they're selling it 3 times a year. Now 3.04 is almost meaningless. Who cares? Is that good or bad? I don't know. But we can look at that number, and we want to have a higher number on that, because the more times it's so turned over, then the quicker things are happening. So a higher number is good. If we compared it to last year and it was 5 last year and it's 3 this year, well, whether I can conclude that that's a good or bad number, I at least know that it actually seems to be getting worse. It's slowing down. We had 5 and now we're at 3.04. We're turning it over less times. That's not cool. Things are going not so well. Now, if last year was 2.5 and this year is 3.04, well, at least we're getting better. We don't know if that's good or bad, but at least we know we're getting better. So what we like to do is take that number and compare it to the industry average. Let's say the industry average is 2.9. We're at 3.04. That would be good. If the industry average is 4 and we're at 3.04, then we have something to work on. We're seeing this as a weakness. We're going to make it a priority to try to improve it. So now that we've computed the inventory turnover rate of 3.04, the PowerPoint, for whatever reason, ignores what is referred to as days inventory outstanding. And what that means is how many days does inventory sit on the shelves or in a warehouse or wherever it is? How long does it sit there? And the longer it sits, the more problematic we have. We want this to be, we want our inventory to turn over as quickly as possible, right? So the question becomes, if we computed our inventory turnover rate of 3.04, can we then use that number to compute the days inventory outstanding? So days inventory outstanding for 2016, the formula is going to be, let's go for days inventory outstanding is equal to 365, which represents the number of days in a year, divided by the inventory turnover rate. Now, the good news is we've already computed the inventory turnover rate. So now we can then begin to solve this by plugging in inventory turnover, which is 3.04. So now that we have the numbers in play, we can compute the days inventory outstanding by taking 365 and divided by 3.04. So on average, inventory is sitting on the shelf 120.07 days, rounded to the nearest hundredths. Now, is that good? Well, not if you're selling milk. Unless you like spoiled milk. But you know, for some industries that may be, if you're building custom homes, 120 days may not be so bad. So it really kind of depends on what you're selling. And certainly what you're going to do is compare that number to the industry average. All right, if the industry average is 150, then you're looking pretty good because you're selling it faster than the industry. If the industry average is more like 99, then not too good. We've got to find ways of improving that. Okay, let's go back to slide 29, where you see the inventory turnover. We just computed this. The next slide is called the accounts receivable turnover, and that's similar. We're going to take net credit sales and we're going to divide it by the average net accounts receivable. Now this turnover tells us how quickly we're able to collect our cash after we've sold something. So this is a good way to measure how good our collections department is working. Generally speaking, the higher the number this is, the better. Accounts receivable turnover rate tells us how quickly we are collecting cash from credit customers. Generally speaking, the higher the better, and it tells us how many times during the year our average receivables are turned into cash. So here's our formula. Accounts receivable turnover is equal to net sales divided by average accounts receivable. So let's take a look on how we actually come up with these numbers. Net sales is going to come from the income statement. So we're going to flip over to slide 10. We're looking at net sales, and we're looking at specifically 2016. So I guess I should put this on for 2016. So our net sales for 2016, let's go to our slide here. This is slide 10. Net revenues, net sales, net revenues, those are pretty much the same. 4825335. 4825335. And we're going to divide that by average net receivables. Well, let's do this. We've got to now compute our average net receivables. That's going to be equal to the ending balance plus the beginning balance, and we're going to divide that by 2. Ending balance plus beginning balance divided by 2. So we're going to try to compute this average net receivables. To get our ending and beginning balance, we're going to flip over to slide 11. We're looking at accounts receivable net. Our ending balance, 622,685. And our beginning balance is 433,638. That's the beginning balance because it was equal to the ending balance of the prior year, 433,638. Those numbers added together should be then divided by 2. All right, so now we're going to take 622,685 plus 433,638. And we're going to divide that by 2. So now we can compute our average net receivables to be 528,162. Okay, so we'll go ahead and put this in a little box here so we know that that's a little computation all by itself. And now we'll go back to this, except now we know that we can substitute an actual number. So the average net receivables is 528,162. Now we have our accounts receivable turnover, and that's going to be equal to 4825335 divided by 528162 to the nearest hundredths, 9.14. So on average, we are collecting our balance from receivables 9.14 times per year. So we've computed the accounts receivable turnover using this formula. Now we can take one step further with this and figure out, okay, what is the days sales outstanding? In other words, the number of days that it is taking us on average to collect our accounts receivable. Well, the way we compute this is we take 365 and divide it by the turnover rate. Accounts receivable turnover. 365 divided by the accounts receivable turnover. And that gives us the number of days it's outstanding. So here's our new formula. Days sales outstanding is 365 divided by the accounts receivable turnover. Well, we've already computed the accounts receivable turnover, so now we can plug that in. So we'll take 365 divided by 9.14. So now that we have the numbers in play, we can now compute the days sale outstanding. 365 divided by 9.14, and that gives us 39.95, but that would be rounded easily to 40 days. So what that's telling us is that on average, it's taking 40 days between the time we sell something or issue the invoice and the day we actually receive the cash from our customers. Is that good? We'd have to compare it to the industry or compare it to the prior year. So if we're at 40 and the industry average is 50, we're thumbs up because we want to collect our cash quickly. We want that money to come in as quickly as possible. So 40 is good. We get that number quick. If the industry average is 50, then we're doing well. If the industry average is 30, well, we're taking longer to collect our receivables. So we've got to look at that. We have to see what's going on. If our prior year was 45 and this year is 40, well, at least we're moving in the right direction. We'd have to take the 40 and compare it to the industry average. But if it's getting better, if the number of days outstanding is getting shorter, then that's a good thing. Okay, so similar to the way we computed the accounts receivable turnover, we can actually compute the accounts payable turnover. The next slide shows the accounts payable turnover. This measures the number of times per year the entity pays off its accounts payable. To compute the accounts payable turnover, we simply take the cost of goods sold and divide it by the average accounts payable. So let's do that for 2016 again. Cost of goods sold divided by average accounts payable. So the cost of goods sold for 2016, let's go ahead and go back to slide number 10. The cost of goods sold for 2016 is 2584724. 2584724. And that's going to be divided by average accounts payable. So first, to go any further, before we go any further, we have to compute the average accounts payable. And this is going to be pretty consistent with what we've done before. We have to take the ending balance plus the beginning balance, and we're going to divide that by 2. So to get the beginning and ending balance, we'll go back to the PowerPoint and scroll down to slide 11. And on slide 11, we have accounts payable, the bottom here. Accounts payable, the ending balance is 409,679. The beginning balance is equal to the ending balance of the prior year, which is 200,460. 200,460. Okay, so we'll keep working down this. We're going to add these two together. and that's going to be divided by 2. So 610,139 divided by 2. So the average accounts payable is equal to 610,139 divided by 2, which gives us 305,070 rounded. Put this in borders here so we know this was an attempt to compute average accounts payable, which is what we need here. So now we're in a position to finish this off. So cost of goods sold, divide that by average accounts payable, which is 305,070. So now the turnover, accounts payable turnover, is equal to 8.47, rounded to the nearest 100. So now that we have the accounts payable turnover computed, we can then compute what's referred to as DPO, or the days payable outstanding. And the way we compute the days payable outstanding is we take 365, we divide that by accounts payable turnover. Now we just computed the accounts payable turnover to be 8.47. So we can restate this. Divided by 8.4. So now we know the days payable outstanding can be 365 divided by 8.47, which is what we computed the payable turnover rate to be. And our days payable outstanding will be equal to 365 divided by 8.47, which is 43.08. Okay, so now we can compute the cash conversion cycle based upon all the computations we've just done. The cash conversion cycle will be computed by taking the days inventory outstanding plus the days sales outstanding minus the days payable outstanding. So we computed each one of these previously. We'll go ahead and figure out what that was. So the DIO, days inventory outstanding, let's go find that. We computed it earlier. Days inventory outstanding, 120.07. The DSO, days sales outstanding, we computed that earlier. DSO, days sales outstanding, that was 40. And the DPO, that was with the accounts payable turnover, and days payable outstanding, DPO 43.08. So to be consistent, I guess we should round it to the nearest hundreds. So we have the numbers DIO, DSO, and DPO. So now that we have the numbers, DIO 120.07 plus the DSO 39.95 minus the DPO 43.08. Cash conversion cycle is computed by taking 120.07 plus 39.95 minus 43.08. Our cash conversion cycle is 116.94. Now, what does that really tell us? The slide 33 shows that the cash conversion cycle shows the overall liquidity of a company. It computes the total days it takes to convert inventory to receivables and back to cash, less the days to pay off suppliers. What do we need to, for how many days do we need to finance this operation? Because we've got to spend money initially in order to sell a product, and when that cash comes in, we're made whole again. So the cash conversion cycle tells us how long it's taking us between the time we have to push out cash and the time that money comes back in. And in this example here, it's taking 116.94 days. That computes our cash conversion.